Hi everyone, today we'll be going over accounts May-June 2021, paper 3-3, question number 1. This is structured paper 3 which consists 6 questions, each of 25 marks, and we are also given a time limit of 3 hours. So we will be attempting to solve each question under 30 minutes. And this question number 1 is part of section A, which relates to financial accounting. So without any further delay, let's get started. G Limited manufactures luxury sofas. In 2020, it also started trading in standard sofas, which are purchased from local supplier. Okay, so what we know is that G Limited is a manufacturing company which manufactures luxury sofas on their own, but recently it also started trading in standard sofas, but these sofas are not produced by them. Instead of producing on its own, they purchase the standard sofas from local suppliers, which means that if we were to make our manufacturing account for G Limited, then we would only record the cost incurred for manufacturing luxury sofas, and we will not be including the cost incurred from purchasing the standard sofas from local suppliers. Those will only be included in our income statement. Alright, then the following balances were extracted from the books of G Limited at 30 December 2020. We are also given additional information. The markup on cost of production for 2019 was 20%, and it was increased to 25% in 2020. This means that the factory profit added on the manufacturing account for the year 2019 was 20%, whereas the factory profit added on the manufacturing account in 2020 will be 25%. This is also the rate for provision for unrealized profit for the finished inventory. So if you're talking about the closing inventory of 2019, that would have the unrealized profit of 20%, right? And the closing inventory of 2019 will act as an opening inventory for 2020, which means that the opening inventory of finished goods will have an unrealized profit of 20%, whereas the closing inventory of finished good will have an unrealized profit of 25%. Let's figure that out. So we are given our opening inventories right here. And we can see that the finished goods or the luxury sofas are priced at 126,000, and we can see that this is at a transfer price, which means that this is the cost plus profit, and this is equal to 126,000. Now what we know is that profit is just going to be 20% of the cost, because that was the rate of the markup on cost of production for the year 2019. So that's cost plus 0.20 times cost equals to 126,000. So cost plus 0.20 times cost is just going to be 1.20 times cost equals to 126,000. Now we can easily figure out the cost of the opening inventory. That's just going to be 126,000 divided by 1.20, which results in 105,000. Now the unrealized profit is just the profit, right? So in order to figure this one out, we can just subtract our cost from the total transfer price of 126,000. So that's just going to be 126,000 minus 105,000, which is 21,000. So this is the unrealized profit associated with the opening inventory of finished goods of luxury sofas. Now we repeat the same process for the closing inventories, and our closing inventories are given right here. So we have our finished goods. We have two finished goods actually. We have luxury sofas as well as standard sofas. But what we know is that standard sofas are purchased from another supplier, which means that we do not have to account for the unrealized profit for this part. We just need to account for the luxury sofas which were made at G Limited. So this is also at a transfer price. So that just means that cost plus profit is 150,000. And what we know is that the profit or the markup on cost of production for the year 2020 is just 25%. So profit is just 25% of cost. We can write it down as 0.25 times cost, which is 150,000. So cost plus 0.25 times cost is just going to be 1.25 times cost equals to 150,000. Now we can easily figure out the cost of the Closing inventory of finished goods for luxury sofas, that's going to be 150,000 divided by 1.25, which is going to be 120,000. Now, in order to figure out the profit or the unrealized profit associated with closing inventory of finished goods, we can just subtract the cost from the total transfer price of 150,000. Let's do that. So profit is just going to be the total transfer price 150,000 minus the cost, which is 120,000, which results in 30,000. All right. Then for the third information, we are given that the selling and distribution cost included transportation of raw materials. This should not have been included in selling and distribution cost because this is basically carriage inwards associated with raw materials. And this should have been included in our manufacturing account. Then we have installation of new machinery. So this is actually a capital cost, because the activity of installing a new machinery is not something that's going to recur over the year. This is a one-time cost, which means that the installation of new machinery of 5,000 should actually be included in the new machinery cost. Let's do that. So we have machinery cost to be 325,000. We need to add another 5,000 to it. So this results in the total cost of machinery to be 330,000. All right. Then for the fourth part, we have factory rent, 48,000, that had been included in the administrative expenses. So this is the cost associated with factory and not the office, which means that this should not have been included in the administrative expenses, but again should have been included in our factory overheads, which we include in our manufacturing account. Then for the last part, machinery is to be depreciated at an annual rate of 20% using the reducing balance method. Okay, so we need to figure out our depreciation on machinery, and since machinery is used in factory, this will be actually associated to the factory cost, which means that it should also be included in our manufacturing account. So let's have a look at our question. We need to prepare the manufacturing account for the year ended 31st December 2020. Let's do that. So we are preparing the manufacturing account for G Limited. And it's a manufacturing account. And we are preparing this for the year ended 31st December 2020. Okay, so if we're talking about manufacturing account, we only include the costs that are related to our factory, and we divide these costs into two sections. The first one is the prime cost, which consists of all of the direct costs. So the first direct cost is going to be that of the direct materials or raw materials. So we are going to include all of the costs associated with raw materials. And this is similar to the cost of goods sold that we used to do in our income statement, which means that this will include all of our opening inventory of raw materials, closing inventory of raw materials, purchases made of raw materials, as well as the costs incurred towards the purchases of raw materials. So that's going to be opening inventory. Then we will add our purchases like we used to do in our cost of goods sold. And we also know that there was a transportation cost for raw materials, which means that there is carriage inwards. So we need to add that cost as well. Then lastly, we will subtract our closing inventory. And with this, we will get our total cost of raw materials consumed. So let's have a look at our above information in order to figure out the amounts for these four headings. Alright, so we are given the opening inventories right here, and for raw materials, it amounts to 66,000. So we need to include this in our manufacturing account. Let's do that. So opening inventory is 66,000. Let's look for purchases of raw materials. we are given purchases of raw materials right here, which amounted to 292,000. Let's include it. So that's 292,000. Now we have carriage inwards, which are given in our additional information section. So carriage inwards actually amounts to 7,800. Let's include that as well. Now finally, we need to look for our closing inventory of raw materials, which was again given in our additional information section. Right here, this gives our closing inventory, and raw materials amounted to 72,000. So we need to include that. And we need to subtract the closing inventory. So I'm just going to put it in a bracket to indicate that. Now we can figure out the total cost of raw materials consumed by adding these four amounts. So that's going to be 66,000 plus 292,000 plus 7,800 minus 72,000, which results in 293,800. Okay, so now we again need to add other direct costs associated with our factory. So let's have a look at the above information. We are given direct wages, so that's a direct cost, right? And it amounted to 200,200. So let's include that. Direct wages amounted to 200,200. Let's look for any other direct costs. So we have indirect manufacturing expenses that will be included in our factory overheads. Then we have administrative expenses and selling distribution costs. These will be included in the income statement. And we have machinery. So for machinery, we need to charge depreciation, which will be again included in our factory overheads and not the direct costs. So we included every direct cost there is. So we can just total and figure out our prime cost. So prime cost is just the total of the direct cost, and the only direct cost that we have is the cost of raw materials consumed and direct wages. So it's very easy to figure out the prime cost. You just have to add these two amounts. So that's going to be 293,800 plus 200,200, which results in 494,000. Now we include the factory overheads, or all of the indirect costs that is associated to the factory. So let's have a look above. We were given the indirect manufacturing expenses right here, so we need to include this, and it amounted to 108,000. Let's do that. That's indirect manufacturing costs, and it amounted to 108,000. Let's look for other indirect costs. Like I said before, we need to charge depreciation on machinery, and this will be the indirect cost associated with the factory, right? So let's have a look at our depreciation policy. So machinery is to be depreciated at an annual rate of 20% using the reducing balance method, which means that the rate of 20% should be charged to the net book value, which is actually the difference between the cost and the accumulated depreciation. Let's do that. So the depreciation charged in machinery is just going to be the cost, which is of 330,000 after adjusting our installation cost of 5,000. So that's 330,000 minus our accumulated depreciation is of 155,000. So that's 155,000. This will give our net book value. So we just need to multiply it with the rate in order to figure out our depreciation charge. And we were given the rate to be 20%. So that's times 0.20. This gives our depreciation per year on machinery to be 35,000. So we need to include this in our factory overhead section. Let's do that. Depreciation on machinery. And it amounted to 35,000. So let's have a look at the above information to see if we missed any other indirect costs. So we are done with the fifth information. For fourth one, we have factory rent. So that's obviously and indirect costs associated with the factory, we need to record this in our factory overhead section. So let's do that. The factory rent is of 48,000. Okay, then we already adjusted the third information, and yes, I think we included every indirect cost there is. So now we can just total the direct and the indirect costs. Let's do that. That is just going to be the sum of these four amounts. So that's 494,000 plus 108,000 plus 35,000 plus 48,000, which results in 685,000. Now we need to adjust our work in progresses, because even though it is not actually a finished good, we obviously incurred costs in order to work on the raw materials, right? So we definitely need to adjust our work in progresses to the manufacturing account as well. So what we do is we add our opening work in progresses, since we always add the opening inventory to our cost, but we subtract our closing work in progresses. And after adjusting our work in progress, we will actually get the cost of goods manufactured. So let's have a look in the above information for the values for the opening inventory of work in progress and the closing inventory of work in progress. So opening inventories are given right here, and we have the work in progress. It amounted to 42,600. We will add this amount. Let's write it down. So that's 42,600. Now for the closing one, it was given in our additional information section, and we have work in progress right here, which amounted to 54,000. So we will be subtracting this amount. Let's write it down. That's 54,000. And I'll write it in a bracket to indicate that this needs to be subtracted. Now, if you total these three amounts, we will get the cost of goods manufactured. So that's going to be 685,000 plus 42,600 minus 54,000, which results in 673,600. Now this gives our total cost of the goods manufactured, but in case of manufacturing account, we also need to figure out the transfer price, which means that we need to add the profit to the cost. So let's add our profit now. And we know that the profit rate or the markup rate was 25% for the year 2020. So this just means that the profit should be 25% of the cost of goods manufactured. And we know that the cost of goods manufactured is 673,600. So we can just multiply it with 25%, which we can write down as 0.25. Now this will give us the profit or the 25% markup to be 168,400. Let's write it down. Now, if we add the cost of goods manufactured to the profit or the markup of 25%, then we will get our transfer price. So the transfer price is just going to be 673,600 plus 168,400, which is 842,000. This concludes our manufacturing account as well as the first part of this question. Now we can move to the second one. We need to prepare the provision for unrealized profit account for the year ended 31st December 2020. So this is going to be quite easy because we already figured out the unrealized profit associated with the opening inventory of finished goods for luxury sofas as well as the closing inventory of finished goods for the luxury sofas. So let's prepare our format. We are going to prepare provision for unrealized profit. So this will be a ledger account or a D account. I'm just going to divide it. This will be the debit side and this will be the credit side. And since we're talking about unrealized profit, our opening balance will be on the credit side. So we can write it down as balance brought down. And this will actually record the amount of the unrealized profit associated with the opening inventory of finished goods. So let's have a look at the above information. We already figured it out. So the cost for the opening inventory of finished goods was actually 105,000, and then the unrealized profit associated with that cost was 21,000. So let's write it down in our provision for unrealized profit account. For opening, that's 21,000. Now, if the opening balance of unrealized profit is on the credit side, then the closing one will be definitely on the debit side. So we can record it as the closing balance or balance carried down. And this will be the unrealized profit associated with the closing inventory of finished goods, which we again already figured out above. So let's have a look there. The cost of the finished goods of luxury sofas is actually 120,000, and then the profit or the unrealized profit associated with it is 30,000. So we need to record this amount in our provision for unrealized profit account. Let's do that. We have 30,000. Now we can see that the provision for unrealized profit has definitely increased because the opening balance is less than the closing balance. Now, if it has increased, then that will be written down as an expense in our income statement, right? So the balancing figure for this ledger account will be that of the income statement because the increment amount will be recorded as an expense. And since the heavier side is the debit side, the balancing figure will definitely be on the credit side. We can write it down as income statement. And the total of this account is going to be the heavier side. So that's 30,000 for debit side and 30,000 for credit side. Now, in order to figure out the balancing figure, we just subtract this amount from our total. So that's going to be 30,000 minus 21,000, which is 9,000. So 9,000 should be recorded as an expense under the heading of increment in the provision for unrealized profit account in our expenses section. So the last thing we need to do is to record our closing balance for unrealized profit as an opening balance for unrealized profit for the next year. So that's going to be balance brought down. And this will have the same amount as our closing balance. So that's going to be 30,000. This concludes our second part of the question. Now we can move to the third one. Explain the treatment of unrealized profit in G Limited's statement of financial position at 31st December 2020. And your answer should refer to relevant accounting concepts. So in case of the statement of financial position, we obviously record our closing inventories, right? But what we know is that we only record the closing inventories at cost. But since we are given the closing inventories of finished goods at a transfer price, which means that it already includes a profit. So this profit is referred to as unrealized profit because the goods have not yet been sold, so we cannot realize the profit right now. We only need to record it at the cost price, right? Let's write it down. So the luxury sofa inventories should be stated at the cost. Now we already figured out our cost above, so let's have a look there. So the cost should have been that of 120,000. Let's include it as well. The cost of 120,000. And we figured this cost out by calculating the unrealized profit had been 30,000 and which should have been deducted from our transfer price of 150,000, right? Let's write it down as well. That is being unrealized profit of 30,000 deducted from the transfer value of 150,000. So this is just the treatment of unrealized profit. We now need to refer to relevant accounting concepts as well. So like I said before, the inventories have not yet been sold, so we cannot really realize the profit. And this actually refers to the prudence concept, which suggests that the assets is not overstated, and since closing inventory is an asset, if we include the profit, it would definitely have been overstated. Let's write it down as well. This is in compliance with prudence concept that the value of assets is not overstated. And if you're not realizing the profit now, then the realization should be done once the goods are sold, which is stated by our realization concept. So this is in compliance with that as well. We need to record it. This is also in compliance with realization concept that the profit is only realized when the goods are sold. Alright, this concludes the third part of this question. Now we can move to the fourth one. We need to prepare the trading section of the income statement for the year ended 31st December 2020, showing separately the gross profit from each of luxury sofas and standard sofas. Alright, so the trading section of the income statement just refers to the part up to gross profit, and we know that we always start our income statement with the revenue. So let's write it down. Let's look for the revenue of luxury sofas and standard sofas in the above information. Alright, so the revenue from luxury sofas is of 944,000, whereas the revenue from standard sofas is of 175,000. So let's record it in our income statement or the trading section of the income statement. So that's 944,000 for luxury sofas. For standard sofas, that's 175,000. Now we just subtract our cost of sales and we start with the opening inventory. So let's have a look at the opening inventory of luxury sofas and standard sofas. And the opening inventory for luxury sofas is actually going to be that of the finished goods, which is given right here. The finished goods of luxury sofas at the date of 1st January 2020 is of 126,000. Let's record it. $126,000. Then for standard sofas, I don't think there is an opening inventory for standard sofas because we were given the information that G Limited started trading in standard sofas in the year 2020, which is the current year, which means that there is not going to be any opening inventory because we just started trading in that particular section in this year. So there's not going to be any opening inventory for standard sofas. So now we can move to the second part, which is going to be the transfer price for luxury sofas and purchase for standard sofas, because we are not manufacturing standard sofas on our own. We are actually purchasing them from another supplier. So the transfer price for luxury sofas, we just figured that out in our first part of this question. Let's have a look there. The transfer price was 842,000. So we need to record this amount in our income statement. So that's 842,000. For standard sofas, we purchased it, and the information is given in the above section. Okay, so purchases of standard sofas is right here. It amounted to 158,600. Let's record this amount in our income statement. So that's 158,600. And finally, we need to subtract our closing inventory. Let's have a look above. So the closing inventories are given right here, and we have the finished goods. For luxury sofas, it was 150,000. This is the closing inventory, whereas for the standard sofas, the closing inventory amounted to 16,000. So let's record these two amounts. So firstly, for luxury sofas, it's 150,000. I'm going to record it in a bracket indicating that this needs to be subtracted. Then for standard sofas, it was 16,000. So now we will figure out our total cost of sales, which is the sum of these three amounts for luxury sofas. So that's 126,000 plus 842,000 minus 150,000, which results in 818,000. And since we are to subtract the cost of sales, I'm going to record it in a bracket again. Now we repeat the same process for standard sofas. The total of the cost of sales is going to be the sum of these two amounts. So that's 158,600 minus 16,000, which results in 142,600. Again, this should be in a bracket because we need to subtract it from the revenue in order to figure out our gross profit. So gross profit is just going to be the difference of the revenue and the cost of sales. So in case of luxury sofas, that's going to be 944,000 minus 818,000, which results in 126,000. Repeat the same process for standard sofas. That's going to be 175,000, which is revenue, minus 142,600, which is the total for cost of sales. Now this will result in the gross profit to be 32,400. This concludes the fourth part of this question. Now we can move to the fifth one. We are given additional information. The directors have the opportunity in 2021 of buying in the luxury sofas, which would sell at a gross profit margin of 20%. So currently, they are only buying in the standard sofas and manufacturing the luxury sofas on their own, but they have the opportunity to buy in the luxury sofas as well. And this would yield a gross profit margin of 20%. We have two options. The one is to continue manufacturing luxury sofas without buying in, like we did just now. And the option two, that's to cease production and buy in luxury sofas for resale. Let's have a look at the question. Now we need to advise the directors which option to choose. We need to justify our answer and support the answer with calculations. So the very first calculation will be to calculate our gross profit that we currently have. Let's do that. So the gross profit margin of luxury sofas. Okay. So this is going to be a little bit tricky because it involves our manufacturing account, right? So we definitely have to include our gross profit. That's 126,000. Let's do that. 126,000. Now let's have a look at this trading section. So what we know is that we deducted our transfer price, right? Because that's a part of cost of sales. So we obviously deduct this in order to figure out our gross profit. But what we also know is that the transfer price also included our profit, and which means that we also deducted the profit in order to figure out our gross profit. So in order to figure out our gross profit margin, we obviously again have to add that profit from the factory back in the calculations. So let's have a look at the first section where we calculated our profit from the factory. So that's just 168,400. And this profit should be added back in order to figure out our gross profit margin for luxury sofas. Let's add it. So that's plus 168,400. Now let's have a look at the trading section again. We added our closing inventory, right? Because that's a negative, and two negatives make a positive. So we definitely added our closing inventory in order to figure out the gross profit. And this closing inventory was also at the transfer price, which means that this again included a profit, right? But we know that the closing inventory should not have been including a profit because these are yet to be sold. And the profit should only be realized when the goods are sold. So we need to deduct the profit associated with the closing inventory of 150,000 or the unrealized profit, right? And this, in the same way, we also deduct the opening inventory, which means that we deduct the profit associated with the opening inventory. So what we can do is we can just look at our provision for unrealized profit account and see whether there was an increment or decrement in our unrealized profit associated with the opening inventory and closing inventory of the finished goods for luxury sofas. Let's do that. So we can see that there was definitely an increase in the provision for unrealized profit, which means that, like I said before, this 9,000 would be treated as an expense. So in order to figure out our gross profit margin right here, we also need to adjust this expense, which means that this 9,000 should be deducted. Let's do that. So that will be minus 9,000. Now these are all of the profits that should have been adjusted. Now we just divide it with our total revenue and multiply it with 100 in order to figure out the gross margin. And we can see that the revenue for luxury sofas was 944,000. So let's write it down. Divided by 944,000 times 100%. Okay, so this is just going to be 30.23%. Now, if you find this conceptual thing difficult, I'm just going to write the formula for gross profit margin of goods manufactured. So that's gross profit margin of goods manufactured. This is just going to be the gross profit, and this will be from the income statement. Then we will add our factory profit. This will be from our manufacturing account, and then we'll see whether there is an increase or decrease in the provision for unrealized profit. Right, so if there's an increase, that's minus increase in unrealized profit. But in the case of decrease, we will add it. So that's plus decrease in unrealized profit. And we just divide it with our revenue. So that's revenue. And then we just multiply it with the 100%. So this is the formula. If you find it difficult to understand it conceptually, it is better to at least understand the formula. Now we can see that the gross profit margin of luxury sofas, if we manufacture it in-house, that's going to be 30.23%. But if we purchase or buy in the luxury sofas from a supplier, we will get a gross profit margin of 20%. So obviously we can see that the manufacturing luxury sofas has a higher gross profit margin rather than trading luxury sofas that has a gross profit margin of only 20%. Let's write it down. Manufacturing luxury sofas has a higher gross profit margin of 30.23% rather than trading luxury sofas that has a gross profit margin of 20%. And if we are to buy in the luxury sofas, then we definitely have to cease our production, right? And ceasing production would incur costs such as redundancy, because we would have to let go of our employees and let go of the machinery as well, which would be costly for G Limited. Let's write it down. Ceasing production would incur costs such as redundancy. Then lastly, if we are to manufacture goods on our own, then we definitely have the control over the quality of the goods manufactured. But if we are to buy in from other suppliers, we do not really have that control. Let's write it down. G Limited can control quality if goods are manufactured. So considering these factors, all of these obviously favor with manufacturing the goods in-house, right? So let's make the decision based on that. The decision would be that the directors should choose option 1, which is associated with manufacturing goods in-house. So this concludes the fifth part of this question as well as this entire question. If you found this video useful, make sure you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.